Hello student, welcome back to IBS. Now we are going to learn about NRV system. What does it mean? Suppose you have sold a product for 1000. Okay. So in your revenue there is 1000k and in your AR balance sheet, this is income statement related, we have 1000k. So at the time when we are closing our books of accounts, the question will come, are we able to collect all this amount 1000k, or we are going to, some of the customer or buyer will be defaulter and they will not pay, so how much amount we will not get. So for solving this question we will go and see our historical data, 1 2 3 4 5 year or 10 year, what percentage of either sales or percentage of AR, account receivable, okay, or AR aging perspective. Further company may either consider entire AR value, okay, as of the closing period, or company may bifurcate this, okay, based on aging, okay, 30 days aging, 60 days aging, 90, 120 days. So maybe the pending account receivable more than 120 day, 180 day, or 365 days. So these are the more doubtful, okay. These are the things that may be regular operations, so you will get it easily. So 90% or maybe 99% you will receive from there, and this maybe you will receive 80% and 20% normally you don't receive. So based on your historical data, okay, you will have to finalize 1000k how much we are going to get in future and how much we are anticipating potentially we will be not getting, okay, or that will be our uncollectible receivable. So this company is targeting 5000. Okay. So total sales value, account receivable value was 1 lakh and your uncollectible receivable is 5000. So the balance remaining 95,000 is, that is called NRV. I hope it is clear to you. Okay. And for entry point of view, whenever you know you are not going to receive this much, okay, that is not 100% sure, but that is anticipated based on historical data. So there may be difference, but overall that will be same. So to declare that, we will debit our bad debt expense and will credit the allowance for account receivable. Okay. So if you can see account receivable, you will have 1 lakh of 1000k fund. Okay. Then you are reducing 5000, so you are having 95,000. Okay, ending balance. So similar way, allowance account, there is 5000. Okay, you have credited balance. Okay, so now when you actually declare any of the invoices, this amount we are not going to receive. And another point is, this is for ending period. Based on December 2023, you are having this much your account receivable balance, and you have decided this month would be our in future after January to December of next year 2024, we are anticipating 5000 would be our uncollectible amount. So as soon as you will be getting report from your marketing team, okay, so these are the client are not able to pay, and whatever the reason, either they are defaulter or they are going with merger and acquisition, or whatever the situation, you finalize that this is we are not going to get. Okay, so that is also a debatable issue whether how you are going to finalize. Okay, so that is not our concern. Our concern is, if it is declared, then you will have to pass the entry. At that time we will not book any expense because expense has been already charged. Okay, so why we are charging this expense in this period? Because account receivable belongs to 2023, so expense should also be charged in 2023. This is the general period point of view. Whichever period your revenue are, expense should also be going to that particular period. So this is the gap rule. Okay, so that is why we are charging here. Then when we actually declare, at that time what we will do, we will debit this allowance account. Okay, allowance account 2000. Okay, and we'll credit the account receivable. So the account receivable was not touched earlier. Okay, you can see this in 2023 when we are passing the entry, we are debiting the income statement and crediting the allowance account. This one is allowance account, but we have not touched the AR. So AR was customer wise, he was having the same balance. Okay, for example, in this there is 10 different customer. Out of 10, one customer has been finalized. This one will not going to pay for 2000k. So that customer balance will be removed by this. Here it is debit balance. So we are crediting it. Okay, so that when you pass sales entry, what you will do? You will do simply AR to revenue, right? So AR you are posting not account receivable. You are posting into actually customer account. Okay, so that customer account will be credited here, and then you will be debiting the allowance account. So allowance account will be reduced by actually being debited by 2000, then you will have balancing figure of 3000. Okay, so if you reduce this here at the end of the period, your AR balance would be how much? 98,000, right? 100 minus 2000. Okay, and for that particular period of 2024, your AR balance is 1 lakh. Then you have reduced, then you have 98,000. This is your value. And allowance perspective, you are having 5,000. Okay, you have reduced 2000, you have 3000. So the point I want to clarify with regard to NRV, okay, by explaining this, your AR balance was 1000k minus 5000, so our NRV was 95,000. Okay, now after posting this entry, your AR balance will be 98 when we are posting this entry. So we are normally debiting allowance account, okay, to AR, right? As I have explained you just now, you are reducing your AR, so your AR will be 98,000 and minus allowance account. Allowance account has become how much? 3,000. Okay. So now how much is your NRV? 95,000. This is also 95,000. So this was your old NRV as per last year. After 2023 close, we have taken accrual, etc. And in 2023, whatever you have declared new NRV before ending of 2023, whatever that time we will do the calculation of bad debt and the method we will do, that is separate. But till now what we did, based on that, before posting the closing entry, our NRV would be always same. Okay, so NRV does not change. The changes will be happening between this allowance account. Okay, allowance account and AR account. If your account is adjusting with your allowance account, so this adjustment is always same, right? So impact of NRV will not be changed. So once NRV has been finalized in that period, so that will remain same for next year till the closing entry has been posted. I hope it is clear to you. So now we are going to learn about how many types of NRV method. Okay, so based on how many method we can calculate our net realized value. So there are two methods, okay, direct and indirect. So indirect, what we will do, when we declare that this is our actual bad debt, this has been decided and declared, that time directly we will post the bad debt entry to our AR part, whatever our AR value would be. So directly your NRV was 100,000k, and then once you have declared, you have posted 1000k entry, you have reduced your AR, okay, then your NRV become 195 and you have declared your expense. So is problematic also. How? Because you have recognized revenue in 2023, okay, but declare bad debt will be later, after 1 year, 2 year, maybe 3 years, because there are a lot of rule and regulation. If company is struggling, in which you have sold your product, if they are struggling, they are not able to pay, but still there is chances they will pay out of total bill, they will pay 50% or something or whatever. So if it has been decided and you are sure that 50% they will pay, 50% they will not pay, so for 50% you will pass entry in 2024. Again 50% you will not pass. Maybe you will declare in 2025. So revenue you have recognized here. Expense you are recognizing in another period. So this is the drawback of this direct method. So that is why this is not applicable in US GAAP or IFRS GAAP. Okay, so that is why this is not popular also. But the benefit point of view, it is very easy. When declare, then only we will pass. We will not keep extra entry and kind of stuff, and so that we will not be struggling with the extra schedule, extra reconciliation we have to prepare when we are following this. Okay, when you are posting allowance entry, and then you are finally decided these are the declared allowance, when you receive back from any of the declared revenue, okay, declare bad debt if you receive, so those entry you have to keep on passing. For all those things you need to prepare a schedule kind of stuff, so that is little bit difficult. Okay, this is easy. Okay, this is acceptable in all the local gap, and US gap and IFRS this is not acceptable. Okay, so these are the few things which we wanted to highlight. So there are two different methods, indirect approach. Okay, one is percentage of sales and another is percentage of receivable. Percentage of sales is simply if you have total sales 10 million. Okay, so maybe on credit you are selling, out of 10 million, at the end of the period you will have 0.2 million of credit sales remaining. Okay, you may be sold entire 10 million, okay, on credit, but at the end of the period you only have, and you receive money also Okay, but at the end you have only 2 million in the receivable part, okay, in balance sheet. Okay, so this is in the balance sheet, this is the sales, this belongs to income statement. So that is why that is called percentage of sales is income statement related method, and this one is balance sheet related method. Okay, so that we will learn in detail, and based on the percentage you may target, this will be 1%, okay, of 10 million will be our bad debt. That amount you will book into your allowance account. Similar way, you will have to decide how much percentage of your credit account receivable or uncollected cash. Okay, based on that, you will decide how much percentage would be our bad debt. Accordingly, you will pass the entry, okay, to your bad debt and allowance account. Okay, so this is the overall all the three method I have discussed. Okay, so thanks for watching. See you into the next session. Stay tuned. Thank you very much.